Did you know a single beverage company just casually crossed the $2 billion mark in a single quarter?
Just casually, yeah.
I mean, really think about that for a second. We aren't talking about some massive tech conglomerate rolling out a new smartphone or a global oil syndicate.
Right.
We're talking about a company that primarily sells aluminum cans filled with caffeinated liquid. So, welcome to today's deep dive. We are thrilled you're here with us because our mission today is to completely unpack the Monster Beverage Q4 2025 earnings report.
And the conference call transcripts, too.
Exactly, which were literally just released on February 26, 2026.
Hot off the presses.
Right. And our goal is to figure out exactly how this brand is navigating a really complex web of global expansion, severe supply chain headwinds, and just rapidly changing consumer habits.
There's a lot to dig into.
It is. We have a massive stack of source material to get through today, from the raw financial data to the strategic roadmaps laid out by their executive team. So, okay, let's unpack this.
Let's do it.
Because the numbers we are looking at are fundamentally changing the beverage landscape. For their fourth quarter, Monster reported $2.13 billion in net sales.
Incredible.
That is a 17.6% increase year over year. But it gets much more interesting when you actually look under the hood. Their operating income jumped 42.3% to hit $542.6 million.
Huge jump.
Yeah. And if you are looking at the per share value, their diluted earnings per share rose 64.9% to 46 cents. They also reported an adjusted actual of 51 cents, which completely beat the Wall Street consensus of 49 cents.
Yeah, and, those top-line revenue numbers are definitely the headline grabbers, right?
Yeah, for sure.
But what is crucial to understand for anyone analyzing this business is that these aren't just empty revenue bumps. You have to look at the margins to see the real story here.
The underlying health of the business.
Exactly. Their gross profit margin actually expanded to 55.5%. That's up from 55.3% in the same quarter the previous year.
Now, to the average person listening, a 0.2% increase might sound like, I don't know, a rounding error?
Yeah, it sounds tiny. But when you apply a 0.2% margin expansion to over $2 billion in quarterly sales, you are talking about millions of dollars in unexpected cash dropping straight to the bottom line.
Right into the profit pool.
Right. And synthesizing why this matters is key here. To get an adjusted actual of 51 cents, which essentially means their profit after stripping out one-time accounting events, it shows the company successfully pulled multiple levers all at once.
Which is not easy to do.
Not at all. They utilize strategic pricing actions to offset inflation, they optimize their product mix to sell more of their higher margin items, and they lean heavily into supply chain optimization to outrun the rising costs of doing business.
So they basically attacked it from every possible angle.
It is a textbook example of operational leverage. They aren't just selling more cans, they are making more money on every single can they sell.
It really is an impressive balancing act. But, it leaves you wondering, if you were running a billion-dollar brand, how would you actually keep that momentum going? Because eventually, gravity catches up to growth, right?
You'd think so.
You run out of shelf space in the United States. But Monster seems to have found this massive secondary engine, and that engine is entirely overseas. Currently, 42% of their total sales are coming from outside the U.S.
That's almost half the company.
Almost half. That international segment is up 26.9% year over year. And when we zoom in on the regional data, the growth is just wild for a mature company. I mean, China is up 78.9%.
Wow.
India is up 54.2%. Latin America is up 90.8% in dollars.
What's fascinating here is how they are actually achieving that international dominance. They aren't just exporting the exact same playbook they use in the U.S. and expecting it to work everywhere else.
Because it wouldn't.
Exactly. They are utilizing a highly strategic, two-pronged approach. In developed markets like parts of Western Europe, for example, sure, they're pushing their premium Monster cans. But in emerging markets, they are aggressively rolling out what they call their affordable energy tier.
Right, the sub-brands.
Yes. These are brands like Predator and Fury. And this isn't some small side project or, a pilot program. Management revealed that this affordable strategy has hit roughly 100 million unit cases.
Okay, I want to pause on that number for you, the listener, because industry jargon can really obscure the sheer scale of what we are talking about here.
Hmm.
A unit case in the beverage industry typically represents 24 8-ounce servings,
Right.
so roughly 192 ounces of liquid per case. So when we say 100 million unit cases, we are talking about billions of individual cans flooding into these emerging markets.
Billions. Yes.
But let me play devil's advocate here for a second. If I am building a premium lifestyle brand, a brand associated with extreme sports, high performance, and a premium price tag in the US, doesn't selling massive volumes of a cheap alternative completely dilute the brand's aura? How do they avoid cannibalizing their own higher-priced drinks?
That is exactly the risk, and it is precisely why they don't call these affordable drinks Monster. They use entirely distinct brand identities: Predator and Fury.
Ah, keeping a firewall between them.
Exactly. It acts as a brilliant cultural Trojan horse. Think about it. If you're expanding into a developing market where a premium energy drink costs a disproportionate amount of a worker's daily wage, you can't just force a $3 can onto the local shelves.
It just sits there.
Right, nobody buys it. So you introduce this affordable alternative, you introduce the functional energy category itself to massive populations where premium pricing is simply out of reach.
You're building the habit.
You get them accustomed to the caffeine, the flavor profiles, and the very habit of a daily energy drink. Predator and Fury have actually combined to become the #1 energy drink brand by value in measured African countries.
#1 by value. That is incredible.
It is. And as those local economies develop and consumer purchasing power eventually increases over time, Monster already owns the shelf space, the distribution pipelines, and the consumer habit.
That makes a lot of sense. You build the infrastructure with the affordable tier and then introduce the premium tier when the market is ready for it. It's the Trojan horse. But, international expansion is rarely smooth sailing. You're dealing with entirely different legal systems, tech infrastructures, and economies.
Exactly. And the earnings report highlights a few glaring examples of those localized risks.
Yeah.
For instance, they suffered a significant distributor systems disruption in Japan.
Oh, I saw that.
Yeah, basically it was a technological hiccup in the pipeline that gets the cans from the warehouse to the retail stores.
And what was the fallout from that?
That single logistical failure cost them an estimated 6 to 7% of their regional sales in the quarter.
Just from a software glitch, basically.
Just from that. Furthermore, when you operate globally, you are entirely at the mercy of foreign exchange rates. In Argentina, they had to completely change their operating model to better manage their exposure to the hyper-fluctuating local currency.
The peso has been so volatile.
Extremely. And the result on paper was a 39.5% decline in dollar sales for the region.
Wait, a nearly 40% drop in revenue? That sounds catastrophic for the Latin American segment.
It sounds catastrophic until you actually look at the physical product movement. This is a perfect example of why you can't just read the top-line revenue and stop your analysis there.
Right.
Despite that massive drop in dollar revenue, their actual physical volume of liquid sold in Argentina increased.
Really? So people are buying more?
People are still buying more of the product than ever before. But because the Argentine peso devalued so severely against the US dollar, the money they brought back to the States was worth significantly less. The underlying consumer demand is incredibly strong, but the macroeconomics just make the accounting look terrible.
Wow. Here's where it gets really interesting, though. How do you create that kind of relentless consumer demand in the first place, whether it's in Buenos Aires or Boston? You build an absolute marketing machine.
And they have one of the best.
They really do.
Hmm.
Monster's cultural footprint right now is massive. Let's look at the fourth quarter highlights alone. The Monster Energy-sponsored McLaren Formula One team won the Constructors' Championship.
Yep.
Their sponsored driver, Lando Norris, took the Drivers' Championship. Over in the two-wheel world, Marc Marquez won the MotoGP World Championship riding for Ducati. Absolutely covered in Monster branding.
Dominating motorsports.
Dominating. And if motorsports aren't your thing, they partnered with the Call of Duty video game franchise and distributed 650 million branded cans across 40 markets.
That is just a staggering logistical feat.
Right. Just think about coordinating game codes, special packaging, and global distribution for over 500 million cans just for one gaming promotion.
And we have to look at how that level of cultural saturation translates directly into hard business returns. It is very different from how sports marketing works, say, 20 years ago.
How so?
Well, think about how Red Bull used extreme sports in the 2000s. It was mostly about brand awareness, right? Slapping a logo on a snowboarder to look cool.
Right, pure eyeballs.
Exactly. Monster is taking that concept and directly tying it to retail innovation. The perfect example from the earnings call is the Lando Norris Zero Sugar energy drink.
Ah, linking the athlete directly to the formulation.
Yes. They didn't just sponsor a globally recognized Formula One champion. They formulated an entirely new flavor profile tied to his specific global appeal and immediately pushed it to market.
Capitalizing on the hype in real time.
Exactly. And that specific drink is already expanding rapidly across 38 markets in the Europe, Middle East, and Africa region.
38 markets.
And now, because of that success, they are rolling it out in the United States, Australia, and New Zealand. They use the sports marketing to secure premium, eye-level shelf space at the grocery store for new products.
Because retailers know the fans will come looking for it.
Precisely. And when we look at those new products, a fascinating duality emerges in what consumers actually want.
Right, the sugar divide. We are constantly hearing about this massive cultural pivot toward health-conscious options. And the data backs it up. Their zero sugar portfolio is soaring.
It really is.
Their flagship Ultra White, which is a zero sugar product, grew by 32% in the quarter. Now, if you only looked at that statistic, you would assume that traditional full sugar energy drinks are a relic of the past, right? That everyone is abandoning sugar entirely.
That's the common narrative.
But full sugar is far from dead. Their Juice Monster line, which is very much a full sugar, calorie-dense product, rocketed up 37%. So how are they managing to grow both ends of the spectrum so aggressively?
They are doing it by successfully targeting entirely different consumer need states without cannibalizing their own sales.
Need states. Break that down for us.
Sure. The person reaching for a zero sugar ultra white at 2 p.m. before a gym session is in a very different need state than the person grabbing a juice monster at 8 a.m. because they want a bold, fruit-forward flavor profile to start their day.
Right, it's two completely different use cases.
Exactly. Monster recognizes that the consumer base isn't a monolith. They have immense depth across their portfolio, capturing the fitness enthusiast and the flavor-seeking consumer simultaneously.
Which is brilliant. But, manufacturing all these different product lines with different ingredients and packaging brings us to the harsh operational realities of 2026. Management was very clear about the headwinds they're facing regarding rising costs.
Very clear.
And a primary concern they highlighted is the cost of aluminum, specifically pointing to the impact of the Midwest premium tariffs on their supply chain. Now, I want to be very clear for you listening. Looking strictly at the business realities of the earnings report, these tariffs are creating a tangible squeeze on their material costs. We are just looking at the math here.
Yeah.
We are not taking a political stance on trade policy, and we are not endorsing any political viewpoints.
Right. Strictly the business impact.
Exactly. And the factual reality for Monster Beverage is that these trade mechanics and the fluctuating global price of aluminum are creating heavy margin pressures. The company explicitly expects modest cost increases to continue into at least the first half of 2026 as a direct result of these factors.
If we connect this to the bigger picture, it is crucial to look at how a company of this size defends against those macroeconomic pressures.
Because they can't just absorb it forever.
Right. And they can't just passively accept higher aluminum costs and pass a massive price hike onto the consumer without eventually losing market share. So the management team detailed their active hedging programs.
Tell us how that works in this context.
Essentially, they use financial instruments to lock in aluminum prices for future deliveries. That insulates the company from sudden commodity spikes.
Buying price certainty, basically.
Exactly. But managing that level of complexity requires incredible internal infrastructure. The earnings report shows a hit to their general and administrative expenses, and a significant portion of that is funding an enterprise-wide digital transformation.
The tech upgrade.
Yes, they are completely overhauling their enterprise resource planning systems, their ERP, and upgrading to SAP S/4HANA with a planned go-live date of January 1st, 2028.
To someone outside of corporate supply chain management, upgrading software sounds pretty mundane, like, oh, we're just getting a new computer system.
Right, just hitting the update button.
But doing this at Monster's scale is like performing open-heart surgery while the patient is running a marathon.
It really is.
You are talking about ripping out the entire digital nervous system of a company that ships billions of physical items across borders, manages dozens of currencies, and coordinates with hundreds of independent bottlers and distributors.
Exactly. A fragmented supply chain system might work when you are a mid-sized domestic company. But when a distributor in Japan orders a pallet of Predator, and the aluminum is sourced from one country, the ingredients from another, and the hedging contract is managed in the US.
That's a logistical nightmare without the right software.
An integrated software system is the only way to track the true cost and profit of that single transaction. It is incredibly expensive and disruptive in the short term, which is why we see it biting into their general and administrative budgets right now.
Taking the pain now for future gains.
Exactly. It provides the scalability and operational efficiency required to protect their margins over the next decade.
So they are mastering international currency fluctuations, dominating sports marketing, and literally rewriting their global software architecture.
Firing on all cylinders.
It all sounds invincible. But there is one area in this report that really stood out as a surprising contradiction.
The alcohol segment.
Yes. While their core energy drink business is flying, the Monster alcohol segment is really struggling.
Yeah.
Sales in that division dropped 16.8%, down to $29 million, and they actually had to take a $51.2 million impairment charge in the fourth quarter.
Yeah. And for those who might not live in the world of corporate accounting, an impairment charge basically means admitting that an asset you own, in this case, parts of their alcohol business or brand value, is worth a lot less than you originally recorded on your balance sheet.
So it's basically a $51 million accounting reality check.
That's exactly what it is.
But why is it happening? I mean, why is it so easy for them to formulate a zero-sugar energy drink and instantly sell it in 40 countries, but they take a $51 million hit trying to sell hard lemonade? Is it just brand confusion, where consumers just don't want alcoholic Monster? Or is it a distribution issue?
It is a combination of both, but heavily weighted toward distribution friction.
How so?
Well, the alcohol distribution model in the United States, the three-tier system, is entirely different from the non-alcoholic beverage network Monster has spent decades perfecting.
Right, because of alcohol laws.
Exactly. You are dealing with entirely different distributors, strict state-by-state regulations, and completely different shelf space negotiations. You can't just put a hard seltzer on the same shelf as an energy drink.
That makes sense. It's a totally different game.
It is. Furthermore, getting a consumer to shift their perception of a brand they naturally associate with morning energy to evening relaxation is a massive psychological hurdle.
That is a tough pivot.
Right?
But what is really telling to me is that they aren't liquidating the division and walking away.
Not at all.
Despite the financial hit and all that distribution friction, they are doubling down on innovation. They're actively rolling out new products right now. They've got the Blind Lemon Hard lemonade line expanding nationally. Yeah. They are shipping the Beast Perfect 10, which is a higher ABV subline of their Beast Unleashed brand. And they have entirely new concepts like Stunt Double Beer and a spirit-based ready-to-drink product called Just 5 slated for the spring.
They clearly believe that the alcohol segment represents a massive total addressable market.
It's too big to ignore.
Right. The ready-to-drink alcohol category is booming globally, and Monster is willing to absorb short-term pain and multi-million-dollar impairment charges to figure out the right product-market fit.
Because the upside is just that big.
Exactly. They know that if they can finally crack the code on alcohol distribution, it opens up an entirely new multi-billion-dollar revenue stream that operates completely independently of their core energy business.
It takes a lot of institutional confidence to sustain those losses while you experiment.
It really does.
And to guide all of this, the explosive international growth, the supply chain overhauls, the marketing campaigns, and this stubborn push into the alcohol sector, they need the right people at the helm.
Leadership is everything at this scale.
Exactly. During this earnings call, they announced some major leadership shifts to support this. They've promoted Rob Gehring to the role of CEO of the Americas, giving him control over North America, Latin America, and the Caribbean.
A huge portfolio.
Yeah. Guy Carling has stepped up as the CEO of EMEA and OSP, handling Europe, the Middle East, Africa, Oceania, and the South Pacific.
Right.
And Emily Tier has been appointed to the role of Chief Strategy Officer to oversee the entire enterprise strategy.
This is a classic, necessary organizational realignment for a maturing global footprint.
You can't just have one person doing it all anymore.
No, when you are generating over $2 billion a quarter, with nearly half of that coming from outside your home country, you cannot run everything out of a single boardroom in California.
It's just physically impossible to manage that effectively.
You have to decentralize leadership. You need the person making decisions for the European supply chain or the Asian marketing rollout to be hyper-focused on those specific regional dynamics and empowered to move quickly without waiting for U.S. headquarters to wake up.
Okay, we have covered a massive amount of ground today, from aluminum hedging and hyperinflation to Formula One sponsorships and hard lemonade. So what does this all mean?
Yeah, let's tie it all together.
If we distill all these financial reports, transcripts, and operational updates down to a single core takeaway, it's this. Monster Beverage is no longer just a domestic energy drink company fighting for convenience store shelf space.
Far from it.
It has evolved into a highly diversified, sophisticated global beverage titan. They are executing a brilliant balancing act, maintaining premium lifestyle marketing and high profit margins in the West, while simultaneously driving massive volume through their affordable energy Trojan horse in emerging markets.
Right.
And they are doing all of this while aggressively fighting off serious supply chain complexities.
Exactly. And the real value for you as someone analyzing this business is recognizing the sheer operational mastery required to pull this off.
It's a masterclass.
It is. Whether your interest lies in corporate finance, global marketing strategy, or international supply chain management, this single earnings report is a masterclass in how to pull multiple disparate levers simultaneously to generate sustainable growth.
It really is.
It proves that maintaining a premium valuation in the market requires constantly opening new frontiers, whether that is a new country, a new demographic, or fighting through the friction of a completely new product category like alcohol.
They aren't showing any signs of slowing down. But before we wrap up, we always like to look slightly beyond the edges of the source material to see where these consumer trends are actually pointing.
And this raises an important question based on a very specific note from the management team. During the call, they highlighted that energy drinks are aggressively expanding across different day parts. Historically, you consumed an energy drink as an afternoon pick-me-up or a pre-workout boost. But now, Monster is explicitly positioning their products, especially their coffee hybrids and the zero sugar lines, as a direct value proposition relative to expensive coffeehouse coffees.
Which are getting very expensive.
Extremely. So here's the thought for you to mull over. As functional, highly affordable energy drinks aggressively push into these new times of the day and begin taking over food service channels, are we approaching a future where traditional hot coffee is largely bypassed by younger generations in favor of a cold, carbonated can?
Wow.
Will the very definition of a morning pick-me-up be permanently rewritten on a global scale?
That is a fascinating shift in consumer behavior to watch out for, especially as those younger generations bring their habits into adulthood. It could fundamentally disrupt the entire morning beverage industry, from the local cafe all the way up to the global coffee conglomerates.
It really could.
Well, that is all the time we have for today. Thank you so much for joining us and spending your time with us on this deep dive. We hope you walk away feeling significantly more informed about the mechanics driving one of the most fascinating beverage companies on the planet. Keep questioning the numbers, keep looking for the bigger picture, and we will catch you on the next one.